Hello, everybody, and welcome to the 100-Year Real Estate Investor. We're your hosts, Jake, Gino, and Teresa. This is the show dedicated to long-term personal financial engineering. Today's guest is an estate tax professional. In 2014, he sold his estate planning law practice in Franklin, Tennessee. Today, he writes for the publication Think About It, founded by life insurance guru Steve Leinberg. The most recent book, Sellout, is available from advancedunderwriting.com. So without further ado, Linas Sudzius, welcome to the show.
Thanks very much. Appreciate the invitation. Appreciate the opportunity to be here.
Hey, it is our pleasure to have you here. And I just want to give a quick note to everybody. We're going to have some nice slides here. So anyone that's listening on audio, please go check out the YouTube if you want further visuals. Teresa, I know you have a long-standing relationship with Linas. Why don't you tell us a little bit about that before we get this started?
Well, you know, in the world of estate planning, which is really the topic that we're talking about today, there are a lot of really fine attorneys out there. But one of the things I really appreciate about Linas is how he can dumb down the topic and the conversation to make it understandable.
I even had a comfortable call with him. That's how good this guy is. Okay, if I can relate with an attorney, I mean, we're doing something here. So
that's right. We had a call together, and wasn't it as plain English? Didn't he communicate these really complicated concepts in as plain English as possible?
He made me feel safe and comfortable, to be honest.
Exactly, which is why I really enjoy working with him. And for those of you out there, if you want to have a conversation with Linas, know that will be available to you. And we'll talk about that at the end of the call.
And why is it important right now? Because everything is changing potentially tax-wise this year. Everything is on the table. 1031 might be going away, step up in basis, capital gains. We're going to be living in a new United States from a tax perspective, potentially. So you got to get this stuff right. It's really, really important.
You got it. And that's a great opening for Linas. Linas, why don't you answer that question? Why is it so important for people to talk about this today and have a conversation with a professional today? What is going on in your world?
Well, no, thanks, Teresa, and thank you both for that really, really generous introduction. I think it's particularly timely for people to think about planning their estates. There's a lot going on in Washington. They're talking about making some changes, and in order to kind of understand the broader context, I think it's important to have a little bit of background information concerning what estate planning actually is, and what the current rules are, and understand how the changes might affect what people are doing today, and what different things they might consider doing as they move forward. And I think in order to understand that fully, you have to have the building blocks. And we're going to talk about some things today that I think are important building blocks to understand what's going on in Washington. We're going to have a really brief overview of how death time estate planning works. We'll review the current federal estate tax rules and why they might be important, particularly for people who invest in real estate or have other illiquid assets. We'll talk about the changes that are on the table, not only with the Biden administration, but with some changes that might happen automatically if Congress and the president do not act. And we'll also talk about some ideas for managing estate taxes for people who have illiquid assets, such as real estate or closely held business interests. And so, if you don't mind, I'll jump right into that.
Oh, please do.
So let's talk just briefly about the estate planning process. What is the estate planning process? Estate planning process is the process of making sure that the right folks get the right stuff in the right way at the right time. That's the part that lawyers and certain kinds of financial professionals help people do. The part that people don't always think about is managing taxes when death time transfers occur. Estate planning focuses on death time transfer, and estate taxes hit when the death time transfer occurs, and those taxes can be managed, particularly if they're thought about in advance and planned for in advance. What are some of the basic tools for planning? Well, if you go to a lawyer, lawyer's going to talk to you about wills and trusts. And really, in order to do proper death time planning you really have to go see a lawyer as part of that process. I'm sorry to say it, I am one, but
He's
you know,
guilty.
you know, a lawyer is kind of indispensable because they got to have the right words in the documents to accomplish what it is that people have in mind. You know, those words, you know, can be a little hard for the layman to kind of get their minds around, but they are words that are tried and tested, and that's why a lawyer is really kind of an indispensable part of the process. And it's not only a lawyer. People have assets titled in all kinds of ways. I don't have to tell this audience about that. It's possible to title, you know, real estate or other illiquid assets in all kinds of ways. Possible in certain locations to have beneficiary designations or transfer on death designations that end up being part of the process. And those things need to be thought about in the broader context of who gets what, when, and what are the tax results associated with somebody getting stuff. It's possible to have ancillary entities, closely held businesses. A lot of times illiquid assets are held in entities for liability management purposes, or to have family or others involved in ownership. That ends up being part of the planning process, and planning for those ancillary entities and the transfer of ownership of those ancillary entities at death can be an important part of the estate planning process. And ultimately, life insurance can play a role. I think people have a natural aversion to life insurance. I do too. I hate paying for it every year. But it can provide money at death, and the money can come at exactly the right time to help manage the estate tax results associated with the transfer of wealth. And so all of those things are, to me, basic tools that are connected to planning around death. And so it's important to understand the role of those tools, and important to understand that all of them need to be considered in putting together a proper plan. We're not going to focus on wills. We're not going to focus on asset titling. We're going to focus on estate taxes because we've got a limited time today. And so what I think is important for people to understand are the current rules with regard to federal estate taxes. And by the way, I'm going to talk about federal estate taxes. I'm not going to talk about state death taxes, either inheritance tax or state estate tax, because each state has its own approach to what might be imposed at death. But by far, for most people with high net worth, federal taxes are the bigger issue, and federal taxes are the ones that need to be thought about and need to be managed.
You need to retire in Tennessee or Florida, basically.
Right. Well, yeah, Tennessee or Florida are very favorable tax states, right? Both income tax and estate tax wise. So it's a great point. But people still in those states still need to worry about federal estate tax.
Correct. You're isolating the problem is what we're trying to do.
That's right. That's right. You're limiting the things that you need to worry about. So let's talk about the key concepts with regard to federal estate taxes under current rules. Right now, you can die and pass up to $11.7 million of wealth to the next generation and not have to worry about federal estate taxes. That's the way the rule is today. $11.7 million worth of wealth. If you're below that threshold, you don't have a federal estate tax problem today. Might have one tomorrow, depending on what Congress and the president do. We'll talk about that more in a second. But $11.7 million, that's what you get to pass free to the next generation without having to worry about anything. If you're over the threshold, every dollar over the threshold that you pass to the next generation gets taxed at 40%.
Just at the federal level.
At the federal level, right? So we'll go through an example of what that means in a second, but 40% is a big number. For people who have high net worth, they certainly have to worry about it. And for people who have net worth that is made up of illiquid assets, coming up with the cash to pay that bill when the time comes.
Fire sales.
Well, fire sales or loans or whatever might be available at the critical time. None of those options are great if you haven't planned for it in advance.
Linus,
So
it appears that $11.7 million may seem like a high number for the average person listening. But as far as asset prices, they've really run up in the last few years. And people really need to take a look at what their net worth is and do that calculation, because 40% is a massive number for
it
anybody out there
absolutely
listening.
is. And you're making the point that the real estate market's gotten hot, right? You know, for a lot of your listeners, their net worth may have increased substantially, even if they haven't done much.
Through no fault of our own. And we've looked
Right.
at it, Jake and myself, and this
Gino's
is why
got a
we
problem.
want you on. It's a good problem. We all have that problem, right? Who are in the real estate business and who have several businesses, but it's something that we never really thought of a couple of years ago, Jake and myself. We were just happy to buy assets. Now we've accumulated them. And as I like to say, proper planning prevents poor performance. So we're talking about planning all throughout this webinar. And this is the start, everybody. Put that number there. You'll be shocked when you start doing your net worth and your personal financial statement that, wow, I'm either getting there or I'm above there. So now what's the next step, man? The next step is I don't want to pay 40%. How do I avoid that?
Well, and it's even, you know, in a way, the anxiety is even worse because of what might happen in Washington.
Yes.
And we'll talk about that in a second, but let's focus on what it means, you know, right now. Let's take Fred as an example.
Oh, I thought you were just going to cut him in half.
Yeah, we don't need to do that. He's he just rejoin himself, right? You know, that would be it. But so let's pretend Fred is single for a second. He's got a $20 million net worth, and he's got one kid, to make the example really straightforward. If he passes this year, his estate, after the exemptions subtracted out, $11.7 million, he's got an $8.3 million taxable estate. At a 40% tax rate, that means $3.32 million in estate taxes. And that's got to be paid within 9 months of his death in cash. The IRS doesn't have a sense of humor about that.
And Fred's illiquid.
Yep, Fred is illiquid, right? It's if it's all real estate holdings of $20 million, his daughter's got to figure out how to raise $3.32 million in cash within a short period of time.
So, Jake, we would like to find Pebbles and buy her assets, wouldn't we? That would make her a motivated seller, but we're trying to avoid that.
We want to
situation.
protect Fred, though, here.
Yes.
Okay, Gino, we got to protect Fred, okay? And we got to protect Pebbles because, look, who do we care more about than our children, right? And it sounds like Pebbles could be in some trouble here.
And
That's
here's
right.
the issue that I see all the time with our clients. They have an idea that I don't need insurance for insurance sake. I have enough assets. And what they many times don't understand is the urgency of having reserves and liquidity 9 months after the time of death, because that's when that tax
Or a death
goes due.
benefit.
Or a death benefit, exactly. And so the misunderstanding or the confusion comes in. I've got plenty of assets to do whatever needs to be done once I die. Linus, can you address that real quick? Because that really is a big issue.
Well, that's it. I mean, you make a great point, Teresa. You know, and I said it as well. The estate taxes have to be paid within 9 months of the date of death in cash. You've got somebody with high net worth made up, you know, almost exclusively of illiquid assets. They've got a cash crunch, right? Something happens. And it might not just be from estate taxes for people invested in real estate, right? There might be cash crunches associated with other parts of what it is they're doing, whether it's mortgages or whatever. They may be exposed in the event something happens to the main person in a way that they don't expect. And so obviously planning for that makes a lot of sense, whether it's with a cash reserve, probably not, but more likely with life insurance, because life insurance provides the cash at exactly the time that it's needed. It's a great tool for that.
Yeah, and if you look at like the way Gino and I are set up, we get cash, we go buy another deal. We build up cash, we go buy another deal. We have a great cash flow machine, so there's really good cash flow. But you know, if I put myself in Fred's shoes and my daughter Pebbles, maybe she's an artist, maybe she's not interested in real estate, but we have property managers, we have people managing that. So say this happens, I don't want Pebbles having to try to figure out how to sell something that she may not really fully understand or have to rush to sell something to create a liquidity event to simply hold the stuff that's supposed to be residually paying her every month. Okay, we built this city on cash flow. Okay, that's what our real estate is supposed to do for us. So we still need some way to preserve that long term in the instance that our children are not as business savvy or into something else. We still want that asset to pay every month, and we want to retain that asset. We see right now, to Gino's point earlier, asset prices are running. It's hard to find cash flow right now. You want to preserve. You have the golden goose. Don't kill it. That's the point. So,
it's a great point, Jake, and that's right. Coming up with the critical amount of cash at the right time. If you've got a plan for that, it allows you to keep that cash flow going,
Yep.
assuming that you've put together a successful real estate operation.
Yep.
So that's the example of Fred, who's single. Well, we know Fred in the real cartoon world is not single. We know Fred is married. And so there are a couple more concepts that I think it's important for people to know about. First of all, is that there is an unlimited marital deduction for U.S. citizen spouses. What does that mean? That means that you can pass $20 billion to your surviving spouse without having to worry about estate taxes. So you probably heard me say earlier that estate taxes are an issue when wealth gets transferred to the next generation.
Mm-hmm.
And that's what I'm talking about. When the first spouse dies, we're usually not worried about federal estate taxes. It's only when both spouses are gone and wealth is being transferred to the next generation that we're worried about estate taxes. So that's a key concept. The unlimited marital deduction can pass as much to surviving spouse as we want without having to worry about estate taxes, provided surviving spouse is a U.S. citizen. And then one other thing that's important in the estate tax rules, at least as they're configured currently, is that if you don't use up all $11.7 million of exemption amount at the first death, surviving spouse can plan properly and carry over what is not used until the second death.
Okay.
So what am I talking about there? Well, let's go back to the example of Fred. So we've got Fred, real estate holdings worth $20 million net, married to Wilma, properly married to Wilma in this example. They have one daughter, Pebbles. At Fred's death, he leaves his whole estate to Wilma. This is what is called the I love you plan, right? At either spouse's death, everything goes to surviving spouse. When both spouses are gone, everything goes to their kids, right? So that's the plan that Fred has in place. And so when Wilma ends up being in line for inheriting the assets, and let's just assume for the sake of this discussion that everything is titled in Fred's name, everything goes to Wilma. That's what his estate planning documents say. Well, does Wilma pay any federal estate tax? And the answer is no. Remember, we just introduced the concept that there is an unlimited marital deduction. Fred can pass as much as he wants to Wilma. In this case, he passes all his wealth to Wilma, and there is no federal estate tax due because it's all going to surviving spouse. And let's assume that Wilma is a U.S. citizen. Just to put that on the table.
Straight out of Bedrock.
Bedrock, Minnesota, let's say. All right. So in any event, so Wilma gets all of this $20 million worth of wealth, no federal estate tax. We didn't have to use any of Fred's $11.7 million exemption because the unlimited marital deduction took care of the estate taxes. We didn't have to use that $11.7 million that Fred had. So Wilma is able to preserve Fred's unused exemption by filing an estate tax return on his behalf. And so at her subsequent death, assuming it happens this year before any changes are made, she gets his unused exemption, $11.7 million, and adds it to her exemption at her death of $11.7 million. And so they've got a total exemption of $23.4 million. And that's available to Pebbles. And Pebbles has inherited an estate, a net estate of $20 million, and the $23.4 million combined Fred and Wilma exemption now completely shelters that estate from estate taxes. And so, that's how the current rules work. It's good news for people who are worth less than $23.4 million. But for those that have managed to put together, despite the federal government's best efforts, a substantial estate worth more than $23.4 million, well, they still have to worry about the estate tax exposure. And so that's what we're talking about based on today's rules. Now, I promised your listeners that I'd help create a little more anxiety on their behalf. So let's talk about some of the changes that might be happening with regard to federal estate taxes. One of the changes is an automatic change. As part of the Tax Cut and Jobs Act, this federal exemption amount was increased from the then current $5 million indexed for inflation to the current level, which is $11.7 million. Well, part of the reason that change was able to get through was because there's automatic grandfathering.
Sunsetting, if you will.
Yeah, exactly. That's right, sunsetting. Yeah, thanks for that. So this provision, this $11.7 million adjusted for inflation exemption amount, is scheduled to sunset in calendar year 2026, where it's going to go back to $5 million adjusted for inflation. Now, this will occur if Congress and the president do nothing.
And that's why it's not on the table right now of proposed changes, because it's already set to expire, probably, right?
Well, that's it. I mean, there's a certain amount of leverage that I suppose the Biden administration has, as it puts its proposals forward for Congress to consider, is that this will happen if Congress and the president do nothing between now and 2026.
You have a window, folks.
Yeah, exactly. So, what is it that the Biden administration is proposing for the change? Well, the answer is that they're proposing reducing the exemption amount, and I've seen it published. There's a link in the slide, but I've seen it published in various places that they're hopeful to reduce the exemption amount, if not to just the $5 million that will happen automatically, perhaps to as much or to as little as $3.5 million. And they're also talking about potentially increasing the amount of the estate tax rate. Well, if the exemption amount gets reduced from the current level of $11.7 million down to $3.5 million, there are a lot more people that have to worry about estate taxes. And if
feeling nauseous over here.
Yeah, thanks for that. It means you're listening, right?
It's not the bearer of good news.
Seriously.
We got sunsetting going on. We've got going from 11.7 to at least 5 or 6, and we're probably going to 3.5. And the rate is going up. I mean, could it get any worse than that, everybody?
I can go into a philosophical rant as to how this is a tax on a tax and how outrageous it is, but we'll table that.
What, because you already paid tax on your money and they're asking for another round?
Yes, exactly.
We just want to be proactive. This is what it's all about. This is why we're bringing this information here, because it's very relevant. Let's be proactive. Let's figure out how to solve the problem. We're not here to complain about what's going to happen, what's not going to happen. We are 100% responsibility junkies, Jake. This is the 100-year real estate investor.
That's what we're doing here. 100% responsibility junkies, but we don't have to like it when it's getting forced down our throat.
Well, and to be fair, these are just proposals. But as I said earlier, if Congress and the president do nothing, the exemption is going to go down. And
Listen, it's still sick and twisted thinking. All right, I don't care.
Well, it is sick and twisted, but regardless, it may end up being the law of the land, and so making plans in advance makes perfect sense, right? It's consistent with the philosophy you guys are mentioning. If you're going to be in this for the long haul, be in it for the long haul, and make plans for the long haul.
That's right.
Mm-hmm.
Got it.
Right? So those things need to certainly be thought about. And if you weren't anxious yet, let me add one more thing. One more Biden administration proposal is the American Families Plan, which would impose and which would end the stepped up basis at death for situations where there are built-in gains of $1 million or more for somebody who's single, or $2 million or more for a married couple.
Explain the impact of that, because I don't think a lot of people. I think this goes over. This is more significant to me than anything.
Huge.
And I think it should be called the anti-families plan, because all it's doing is punishing children.
It's an
really what it
oxymoron,
is.
isn't it? An oxymoron. This is trying to help families, but it's actually going to destroy
No, you're
families.
literally destroying families, and you're going to create situations where parents pass away, and families literally were counting on something, and then it's poof, it's gone, and they're destroyed. Literally. So please do your best to dumb it down for simpletons like Gino and myself to explain what that means when you take that step on basis out.
Sure. So let's say that I buy a piece of real estate and I have it in my own name and I buy it for, pick a number, 100 grand, right? I buy it for 100 grand. So that's my basis in the property. And let's ignore depreciation and all of those things that I might be doing with that thing along the way. And let's say that at the time of my death, the property is worth $1 million, right?
Mm-hmm.
One of the good things that we've got in federal law today is that when I die and pass that property to, let's say I pass it to my son, right? When I pass that property to my son, he doesn't get my $100,000 basis in that property. It gets adjusted to whatever the fair market value is at the time of my death. So if my son inherits the property from me, his basis isn't 100 grand, it's $1 million. And so if he decides, for whatever reason to go sell that property the next day and he gets the $1 million that it's worth, he pays no capital gains tax.
Mm-hmm. And Linas,
So-
Hold on. Keep going with it. But if this is implemented, what they're talking about, right?
Right.
And in that year that you pass away and he gets the $1 million property, what happens then?
Well, that's it. That's the unknown. There are a couple of things that are floating around. The first is that they would simply eliminate the step up in basis.
In that
right?
scenario, walk that through so we understand what that looks like.
So if my son inherits the property from me, he would get my basis of 100 grand. And so, whether he sells the next day or whether he sells 10 years from then, his basis is 100 grand. And so he's got to pay capital gains on the difference.
In that first year, if I'm not correct.
Right.
So
hang on, that's the other
Yeah.
part. That's the other part. They're also talking about imposing a capital gains tax on the inheritance when my son inherits it, right?
Oh.
So $900,000 he's taxed in year one. You talk about it being illiquid. You got to come up with 43% because that's the proposed capital gains on $900,000. Okay, let that sink in. If that doesn't hurt,
Is this
that is
making-
the most.
is this making you mad?
No, I just speak with passion.
Okay.
Well, it'll certainly make a lot of people mad, right?
Mhm.
If that ends up being coming true.
Is that clear? Did you, so I sometimes run fast on things. Is that clear? At least Gino did. Teresa, that makes sense. What I was saying.
Yes.
Maybe Linas, you explain it again, just because I want that to sink into people. The devastation that will cause on an estate.
Yeah,
And what I also want to
Yeah.
clarify, we are talking about real estate. This is the 100-year real estate investor. But if you have other investments, this isn't
Mhm.
just real estate.
Yeah.
This is any investments. If you've got a small business that you want your family to inherit, if you've got stocks, bonds, other assets, this is everything, not just real estate.
Mhm.
And I don't think the average person has any clue that this is on the table right now. It's pretty sad. So.
Well, and to close the loop on that, Teresa, it's a great point. It doesn't just apply to real estate; it applies to all capital assets. And Jake, to your point, in the example that we were talking about, if my son gets my $100,000 basis, and if this change, the worst version of this change ends up being law, means that 900 grand, the difference between what I paid and what it's worth at the time of my death, my son ends up having to pay capital gains tax, and capital gains tax might be taxed as ordinary income, right? And that's why you came up with the 43% tax on 900.
It's almost 400 grand.
Right, exactly.
Due
So,
in 9 months.
In a way, that's worse than the estate tax changes that we're talking about.
Yes.
And
Right.
this is the little zinger that no one really knows. Step and base. I have no idea what that is. Right? There's most people, and then throw that little zinger in there. You're done.
And again, due in 9 months. So there's got to be enough liquidity in the estate so that there's
Yeah.
not a fire, what do they call it? A fire sale, right?
Mhm.
And imagine all these baby boomers, and maybe you could speak to this real quick, Linas, so that people understand. One thing is to have a death when you're young that, most of us that are young think, I'm not going to die forever. Like, I can put this off. But the amount of money or wealth that's being transferred from the baby boomers dying to the next generation. Let me
That's
speak
what
to
they
that
got.
real quick.
It's got a target. They got a target on that, Teresa. That's
Yes,
what's going on.
they do. They know this is not an accident. This is by design.
Mm-hmm.
And I don't even know the numbers on this. I have no clue, but I'm going to guess, Gino. What year did your mom buy her house?
Jake, 1988. So she has no basis off. This been, the
and I don't want to get too personal, but I think you probably know the numbers. What'd she pay for in '88? If
she
you
built
remember?
it for $400,000. Now it's worth probably a little over $1 million.
Think of that, because all these folks, right, that are in their 70s and 80s that bought their homes 30 years ago or whatever, they've stayed in them. They got a bullseye on those right now.
Mm-hmm.
So.
Yeah, and Teresa, you made a great point. I mean, there's a lot of wealth that will be transferring from the baby boom generation to the next generation, and these changes will have a dramatic impact. And if folks aren't planning for it, if these things come true, it's going to be devastating to families and financial legacies. Great point. So let's talk about some ways that people can manage the estate.
Yeah, bring us back up here. We went dark. That's like as dark as we get on our show. So we gotta find. Give us some tools. Give us some shields. Give us a sword or a pitchfork or something. Tell us what we can do.
He's got a picture of a family here.
This is the family plan.
Lit up right now. Got the family plan going on.
Well, this is the personal family plan, not the federal government's version.
Right?
So gifts to family that are made right now, well, they can reduce future estate taxes. It doesn't take a rocket scientist to figure out if you give $1 away today, that's $1 less that you have to worry about estate taxes on in the future, right? So making gifts to family can reduce future estate taxes. So that's one strategy that can be followed. We'll talk about a little bit of nuance here in a second. It's also possible for people to make gifts to charity that can provide some satisfaction and multiple benefits. Reason families listed first is that people usually care about their families more than they care about charities. No offense to anybody. It's just the way that it is. We want to make sure our family's taken care of first. And then if we've got charitable objectives as part of what we're doing, we might consider making gifts to charity, but family would come first. So let's talk about gifts to family and how those might work. You're allowed to give stuff up to $15,000 a year to anybody you want without having to do anything special. So if I've got, for example, 4 kids, I could write each one of them a check for 15 grand in a year as a gift. I don't have to worry about gift taxes. Now, people get gift taxes and income taxes mixed up all the time. We're talking about gift tax consequences. You don't get any kind of income tax deduction or anything for gifts to family. The government wants to limit how much you give to family because it wants to be reasonably sure that it's going to collect estate taxes at the proper time. And so it does limit that. But in any event, gifts up to 15 grand per person, exempt from any kind of special reporting. And you can give anybody you want 15 grand. You can give the postman 15 grand if you want. Right?
Linus is accepting checks, guys.
Well, that's part of it. As much as your listeners may value what it is they're hearing today, they're not going to send me a check for 15 grand because I'm not family, right? They're not going to send you guys each a check for 15 grand because you're not family. No offense to all of us. It's just we're not in the line. And so it's usually family that ends up being in line for substantial gifts, and the government limits how much you can give. And if you give more than the amount that is allowed, you have to worry about gift tax consequences. Gift tax rates are the same as estate tax rates, 40%. So one of the other things that people can do is that they can make lifetime gifts, not just annual gifts. $15,000 a year is an annual gift. Nothing special needs to be done. The government recognizes that people make regular gifts to their kids up to a certain amount. You can make bigger lifetime gifts and use up part of your exemption, right? Current exemption is $11.7 million. If you want to, make a big gift to a family member, you can do it now. And the consequence is you got to file a gift tax return and use up part of your $11.7 million lifetime exemption. And so it's a question, when does that make sense? Well, it makes sense for people with high net worth to consider if they're trying to manage estate tax exposure, because if they've got, for example, real estate holdings that are appreciating rapidly, worth say $500,000 today, but might be worth $1 million tomorrow if certain things happen.
Mm-hmm.
It might make sense to think about giving those assets away so that the appreciation happens in somebody else's hands.
Yes.
Rather than in the successful investor's hands,
Mm-hmm.
right? So those are reasons to think about making big gifts today.
Mm-hmm.
And one thing I will say,
ahead.
it sounds great, but exactly what are you doing when you give a gift? You are losing control and ownership of that asset
Better hope Pebbles knows what she's doing.
Well,
while you're living, right?
Uh-huh.
yeah, and you're all making great points. It's one of the reasons why people don't make big gifts, right? The people who are listening to you today haven't gotten where they are, haven't been successful because they've given up control.
Yeah.
Right? They've been successful because they've retained control, right? They've exercised control. And so giving up control ends up being a little bit problematic. And it's why more people don't make sizable gifts to family members, perhaps until later in life, when they know who the family members are in terms of their skill set, and they trust them a little bit better to make the right kinds of decisions with regard to what it is that they get. So those are excellent points. And it's not, making gifts to family is not a be all and end all in terms of solution, but it is one thing that can be considered depending on what you got.
It's an option, but you got to wait till Pebbles is out of her EDM festival phase and she's got a little more, her head's screwed on a little more squarely, I guess. You got to wait a little bit. So
I don't know.
Well, and that's right. And it might be that, the Flintstones will make more smaller gifts for Pebbles benefits and might use them in a way that that would help them meet other needs. For example, so let's say that Fred and Wilma join together, they each give Pebbles 15 grand for a total of 30 grand. And let's say that it's cash. And so the cash won't necessarily grow. The risk associated with Pebbles managing cash, there is some risk there, but if she hires somebody to help her invest, it's all right? It's not that big a deal. Yeah. And certainly what can be done is that Pebbles can use 30 grand in cash gifts from the elder Flintstones to buy life insurance. And the life insurance can be used to help Pebbles deal with the estate tax issue or potential capital gains issue associated with her parents' death, right? Mm-hmm. So, ideas can be mashed together to help make sure that the right stuff happens at the right time.
And it's fixed and it's growing from that point. And then so you're passing it down tax-free, you're putting it in something to manage the estate when that day of reckoning finally comes. Yeah,
exactly right. And, in this example, because, we're presuming Pebbles is young, we might put together a trust that is for her benefit to make sure that the right stuff happens in the right way at the right time for Pebbles, because maybe she's not ready. She's not prepared to be able to make those proper decisions. And so if life insurance is involved, this is where we're sometimes talking about a life insurance trust, an irrevocable life insurance trust. To make sure that, again, the right stuff happens in the right way at the right time. So that's one thing that the Flintstones might do to help manage their exposure. The Flintstones also, particularly if they're sophisticated investors, might consider making more sophisticated gifts. And let's say that Fred and Wilma have a $20 million estate, and they're worried about this $3.5 million estate tax exemption, and they're prepared to give away their whole estate, or a substantial part of their estate to help manage what might happen in the future. And they've got a piece of property that's worth $5 million that they're willing to give to Pebbles now, right? either because she can manage it, she's connected to it, or they're not really worried about it. Maybe there's a management company in place, and they're just it's kind of self-managing in a way. And so they're gonna make a big gift to Pebbles now and use up part of their exemption amount. Well, instead of making the outright gift of the real estate to Pebbles, Fred and Wilma decide, well, we still want to kind of manage it and kind of oversee it a little bit. So let's put together a business entity. Let's put a wrapper around this piece of real estate. Let's put together an LLC that's taxed as a partnership as the wrapper. Might help with liability management. And instead of giving Pebbles the property, we'll give her part of the LLC. And we'll name ourselves, either directly or indirectly, this is Fred and Wilma talking, we'll name ourselves the managers of this LLC. There you go. And so Pebbles has real ownership, right? After the gift, would have real ownership in the LLC. And that would get out of Fred and Wilma's estate. But if they do it right, Fred and Wilma are still able to exercise management control over the property. Now, there are a lot of moving parts to that.
No, it's clear.
Well, but in the real world, there are a lot of moving parts to that, right? And there are some technical things that the Flintstones lawyers would have to make sure are done right. But it's still an idea that can make sense for a lot of your listeners.
Mm-hmm.
So that's one way to make a sophisticated gift, and it's a way that would, if in theory, make Pebbles happen as well as Fred and Wilma happy as part of this overall plan. Pebbles would probably be relieved that she doesn't have to manage, right? So I think it's an
and she's
idea.
appreciative that mom and dad cared and took the time planning this out so that while they all had a great life together, when they're gone, they lived their life a certain way. And they allowed for that same philosophy and mentality to carry on to the next generation.
Exactly, right? That mom and dad wanted to make things as easy as possible, but financially successful as possible for her as the next generation. Great point. So it's also possible for the Flintstones to make gifts to charity, and anybody can make gifts to charity. The law allows you to make an unlimited amount of gifts to charity. Certain kinds of gifts can also generate income tax benefits, right? For those who itemize on their income tax return, might generate an itemized deductible charitable expense. And there are all kinds of sophisticated gifts that can be made here. Some of your listeners may have heard of things like charitable remainder trusts, charitable lead trusts, or planning around family foundations. All of those things can play a role in an overall estate plan, particularly if someone has real philanthropic intent, right? You can merge charitable planning with estate planning, and in a lot of cases, it can make the estate tax exposure better while achieving family objectives. But evaluating that and figuring out what to do really requires an in-depth conversation with accountant, lawyer, thinking about charitable intent and how what the family needs are, and merging those things together, synthesizing those things together in a way that makes sense for a family. Here's one example of how that might work. Let's talk about Fred and Wilma again. They've got an estate worth $20 million instead of $10 million. Let's change the example. The whole estate's worth $20 million, not $10 million. And let's say that they've got a strong relationship with their church. Could be a synagogue too, but let's just say it's a church. So $10 million, they decide to leave half of their wealth to their church. If they do that, if they leave half their wealth to their church at death in their estate planning documents, they get an estate tax deduction for what they leave to their church. So instead of their whole estate being worth $20 million, their estate is worth $10 million for estate tax purposes. And they avoid federal estate taxes based on today's rules.
Mm-hmm.
Another alternative would be for Fred and Wilma to make a right now gift of a hard to manage piece of real estate that has inherent capital gains built into it. They might consider making a gift to a charitable remainder trust. The charitable remainder trust is something they go to a lawyer to draw up. They transfer the real estate right now to the trust.
Mm-hmm.
They'd keep an interest in the trust of income during their lifetimes. And whatever's left in the trust after they're gone goes to charity. That's where we come up with the name Charitable Remainder
Mm-hmm.
Trust, right? The remainder goes to charity after Fred and Wilma are done with it. And so if you do that right, couple positive things for Fred and Wilma. First of all, when the trust sells the property that they give to the trust, there's no capital gains tax that Fred and Wilma have to pay.
Mm.
So if you got somebody who's looking for an alternative to a 1031 exchange and is charitably inclined, it's something to consider. Not saying it works for everybody, it's just something to consider.
This is great because ultimately, if you don't want your lifetime wealth being sucked into a federal vacuum to go poof to the bureaucrats that, who knows where it's going. This gives you the ability to say, hey, we want to be charitable, but we're going to give it to an institution that we believe is, going to use the money for what we want to do and the causes that we believe directly will have a greater impact on society than the federal vacuum. So I think it's great.
Yeah, it's a great point. And, that kind of planning would ultimately reduce the value of that property from Fred and Wilma's estate.
Direct impact versus throwing it on a fire.
Yeah, exactly.
Yeah.
And if Fred and Wilma are really, really wealthy, they can consider putting together their own charitable organization. They can either make it so that it exists right now and get started with it while they're alive, or they can put words in their estate planning documents that creates a charitable foundation after they're gone. As long as they've got the right words and the organization is operated the right way, their own charitable organization can receive gifts of real estate or cash or whatever after they're gone. And those gifts can qualify for an estate tax deduction. And so there are a lot of planning opportunities available in connection with charitable planning. They can meet multiple objectives. There are lots of creative ways for people to go about thinking about that. And so my point in our short time together is not so much to educate everybody about how those work. It's more about opening up the world of possibilities and inviting people to have, more in-depth conversation about what might be the right fit for them in the context of estate tax management planning.
Mm-hmm.
So the Linas Foundation.
Yeah, thanks for that. Yeah. So ultimately, our clients, I think, are motivated to not only with their charitable intent, but to make family happy. And so you got to integrate both things, right? You got to integrate charitable planning with family planning. And so, from my perspective, to kind of wrap this up, I guess the points I'd make is that if you're going to do estate planning, you got to think about dying. You got to imagine dying, but you got to think about what's important and what it is that you're trying to manage. If you want to manage taxes, it helps if you get started early. And the options tend to be more complicated. The strategies tend to be more complicated the more illiquid somebody is. But life insurance can play a role, and thinking about it in advance can really open up the possibilities for folks. And working with a professional team that understands how these things hang together, that's really invaluable. I suspect most of your callers have gotten good advice. It's the reason, or most of your listeners have gotten good advice. It's the reason they're successful. And so this is no different. Getting good advice as part of this process really kind of helps make things hang together. And I'll let you guys ask whatever questions you got and close with this idea.
So Jake and Teresa, it comes to mind for me when you're a 100-year real estate investor, one of Stephen Covey's 7 habits is start with the end in mind. So I want everyone right now to start with the end in mind. when you're on your funeral, your deathbed, what do you want to see around you? To me, I want to see my 6 children, possibly my 25, 30 grandchildren. Hopefully, hope have a lot of them around, right? But I want them to say, Grandpa Gino really thought about us and put us first and took care of us. And now I'm reverse engineering that. How do I do that? I go to someone like Linas and I start my plan today, right? Proper planning is so important for the 100-year real estate investor. It's so important to think long-term, right? It's so important to be 100% responsibility junkie. It's so important to have assets versus the liabilities. We're always thinking about assets, but it really comes down to planning and taking control of your life and control of your decisions. Now, there are a lot of tips and techniques and strategies that Linas has gone over in these past 45 or 50 minutes that we've shared. There's a lot of planning going on. So it's really important that you figure out what your plan is, how you want to leave your legacy to your children, to your charities, to your family, to whoever you want to. It's all about your plan.
The only other thing I'll say is like there's stages of grieving. Okay, once you realize everything that he just told you and you're past that anger, it's time to take action and put a plan into place so that you can get those tools out of the toolbox, put them to use. There's opportunities here, so you don't have to end up having your kids get cut in half. I've been going over some stuff the other day, even with there's potential that it could be upwards of 70% if all these things take place, in the worst case scenario. So meaning 70% of everything you're trying to pass on to your children basically is going to have a 70% tax rate once it's all stacked together. So you need to be proactive. You need to educate yourself and then take action. We always say education times action will equal your results. Also, sitting on the sideline and doing nothing in this case will also equal a very bad result. So I think you got to get out in front of this and stay tuned, because over the next 90 days, there's going to be some things moving and shaking, and we're going to have more clarity on what's coming down the line.
What I've seen in my over 30 years of working in finance and, with my legal background as well, it's crazy how many people don't plan, and they've spent a lifetime accumulating assets and accumulating wealth, and they were really, really good at doing that. And because they didn't plan, so much of their money went to the government or went to take care of their health, to medical providers, to doctors, et cetera, to hospitals. It's insane. And Jake, if I may, our conversations and some of the planning that we're doing, we're setting stuff up to take care of your estate tax issue in the future, but still allowing you to have use and control of the money inside of the vehicles that we're setting up. And so we talk about the dual asset strategy. You can use these vehicles inside of the dual asset strategy and plan for estate taxes. And that's the work that we're doing. And it's very, very powerful work. And for those of you who want to learn more how everything we've talked about today can apply to your situation, we ask you to text the word legacy, 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 to the telephone number 214-949-8082. And we can talk about your situation. We can get Linas involved if it's necessary. And again, you can set up a dual asset strategy while protecting your estate. And it doesn't matter how young you are. Jake, how old are you?
In my mind, I'm too young to be doing this stuff. I'm 39 and it just bothers me. But look, I might work for the next 40, 60 years. Who knows, right? So and
I'm picking on you because you did think you were too young. Gino doesn't feel that way so much, right? Gino? I mean, when we get to our age.
Let's dive into this for a second, because the dual asset strategy is important, because I've got the 6 children. People may be out there saying, well, I don't have any kids. I really don't have to worry about my estate. That is the wrong question to be saying to yourself, because you can leave a legacy to anywhere. You can leave this money to your church. You can leave this money to friends. That's the important thing. And
find a great, like Second Harvest, where so much of the money, like 99% of the money goes to actually feeding kids. I'm going to tell you right now, if the government takes your money, 99% of that money is not going to go to a great charity like feeding kids directly, okay? It's going to go into the bureaucratic vacuum and get wasted and squandered like, the rest of our tax dollars do. So If you can directly impact lives, like a great charity like we do, like Second Harvest, put the money towards something like that. You're going to have a bigger impact on this world than, you know, the government taking it and squandering it.
Got it. All you have to do is text the word legacy to 214-949-8082. This was a great, great show. Thank you so much, Linas. Thank you so much, Jake and Gino, for the content. I know it's a lot to think about, but
It's heavy.
so important to do so now.
Awesome.
Thanks, Linas.
Thanks, everybody.
Take
Thank
care,
you,
everybody.
guys.